Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Astera Labs.
If you find our talks useful, please consider subscribe, like, and comment underneath. And with that out of the way, let's just get right into the mission for today's talk.
Sounds good.
Because right now, if you follow the tech sector at all, there's this burning question that's undoubtedly on your radar.
Oh, absolutely. Everyone is asking it.
Right. Is this recent market panic around AI stocks a genuine warning sign? Or is it actually just a disguised gift for investors who are looking to build multi-year wealth?
Yeah, that's the trillion-dollar question right now.
Exactly. So we are focusing our analytical lens squarely on Astera Labs today. We want to figure out if this specific company holds the key to navigating all this current market volatility.
And, the timing for this analysis really couldn't be more relevant. Just to ground us in the immediate context for you listening, it is March 4, 2026.
Right.
And Astera Labs just stepped off the stage at the Morgan Stanley Tech Conference yesterday.
Yep, just yesterday.
And if you tune into the broader financial networks right now, you are just hearing a complete cacophony of noise.
Oh, it's deafening.
It really is. I mean, there is endless chatter about tech pullbacks, sector rotations, valuation fears. But our goal today is to strip away that surface level static. Because when you dive into the underlying data we have on Astera, it presents a highly compelling narrative. We are observing some really aggressive top-line growth, and it's paired with a structural technological moat that is completely critical to the future of artificial intelligence.
Yeah, I was looking at their revenue trajectory just before we sat down, and I mean, the chart literally resembles a hockey stick. It's just straight up.
It's incredible.
But rather than me just kind of reading off the spreadsheet here, how fast is this acceleration actually playing out on their income statement?
It is a remarkable pace of scaling. So we are looking at their trailing 12-month revenue crossing the $852.53 million mark. Yeah. And to really understand the velocity of that growth, you have to look at where they were just a short time ago. Their previous full-year revenue was hovering right around $396.29 million.
Okay, so they've essentially more than doubled their top-line revenue.
Exactly. In an exceptionally compressed time frame. When a company leaps from roughly $396 million to over $852 million that rapidly, it indicates they aren't just, executing well.
Right.
They have positioned themselves squarely in front of a massive macroeconomic tailwind.
That top-line growth is certainly eye-catching, but this brings us to a really notorious stumbling block for high-growth tech firms.
Cash burn.
Exactly, the cash burn. So often we see these companies double their revenue, but their operational costs quadruple in the process.
Yep.
They just burn through cash trying to acquire that growth. So how is Astera actually handling the transition toward real profitability?
This is perhaps the strongest pillar of their entire fundamental bull case.
Right.
They did not fall into that cash burn trap. Astera Labs managed a highly efficient pivot. They went from reporting an $83.42 million full-year net loss directly into generating $219.13 million in trailing 12-month earnings.
That is a massive swing.
It really is. And for you as an investor evaluating the fundamentals, that translates to an earnings per share of exactly $1.29. They've demonstrated that their specific business model scales profitably.
They're turning surging demand directly into bottom-line cash generation.
Precisely.
I want to dig into the mechanics of that profitability for a second, because a significant portion of that has to come from their pricing power and their margins.
Definitely.
Looking at the data, their gross margin is sitting at an incredible 75.69%.
Yeah, it's huge.
Let's put that in perspective for the listener. A roughly 76% gross margin is what you typically expect from a pure software-as-a-service company.
Right, a cloud software company.
Exactly. Yet, Astera's operating in the semiconductor and hardware space. They are dealing with physical supply chains. How are they achieving software-like margins on physical hardware products?
It really comes down to the highly specialized nature of what they engineer, which we'll explore more when we discuss their moat, coupled with just exceptional operational discipline. That 75.69% gross margin triples all the way down to a net profit margin of 25.70%.
Wow.
But the true superpower hidden in their financials is their balance sheet. Astera Labs carries absolutely zero debt. 0%.
Let's just pause on that point for a second, because the macroeconomic environment right now makes that so crucial.
Oh, entirely.
Over the last few years, the cost of capital has been a massive headwind for the tech sector. Interest rates are just a constant pressure point. Having a zero debt-to-equity ratio removes them completely from the mercy of the bond market.
Precisely. They are totally insulated from credit crunches and refinancing risks.
Right.
This pristine balance sheet provides them with a really profound operational safety net. Because they generate positive free cash flow and carry zero debt obligations, they can aggressively self-fund their own expansion.
I don't need to ask the banks for permission.
Exactly. For instance, they have been pouring capital into their research and development footprints, specifically expanding their centers in India and Taiwan.
And those geographic choices, they're highly strategic, aren't they? It's not just about finding cheaper office space.
Not at all. It is a highly calculated talent acquisition strategy.
Okay.
Taiwan provides them with immediate physical proximity to the advanced hardware manufacturing supply chain, most notably the massive foundries out there.
Right.
India, conversely, offers an incredibly deep pool of engineering talent for software verification and design. By funding these expansions internally without borrowing a single dollar, Astera is essentially financing its own hypergrowth while insulating itself from macro capital constraints.
That financial health clearly gives their management a lot of confidence.
Oh, you can see it in the numbers.
Yeah, if we look at their most recent quarter, they delivered a really solid beat. They brought in $191.93 million in revenue.
Against estimates that were sitting closer to $172.49 million.
Right, a huge beat. But the market is a forward-looking mechanism. What really caught my eye was their guidance.
The forward guidance is massive.
They are projecting $206.46 million for the upcoming quarter. They are accelerating off an already elevated base.
And that forward guidance is entirely dependent on the structural demand for what they actually build, which brings us to the core of the thesis today, understanding their technological moat.
Right. Why is the market willing to pay software multiples for a hardware-adjacent semiconductor company?
Exactly. Let's unpack the technology without getting totally lost in the weeds.
Let's do it. If we think about graphical processing units, the GPUs as the brain of the modern AI data center, they're doing the heavy computational lifting.
Right.
Then the memory chips are the short-term recall. But as these AI models scale up to trillions of parameters, the data center faces a physical bottleneck.
The physical distance.
Exactly. It doesn't matter how fast the brain is if it can't communicate quickly enough with the memory. So Astera Labs is essentially building the central nervous system to bridge that gap.
I love that analogy.
They provide the ultra-fast, multi-lane highways connecting these components. That's the plumbing of AI.
That captures the essence of their role perfectly. The industry refers to the major cloud providers, Amazon Web Services, Google Cloud, Microsoft Azure as hyperscalers. These hyperscalers are racing to build unprecedented AI infrastructure. But as they physically scale up these data centers, sometimes even utilizing liquid cooling, which requires more physical space between the components, signal degradation becomes a really critical issue.
The signal literally drops off.
Right. Light and electrical signals can only travel so fast and so far before they lose integrity.
So the data is struggling to cross the physical distance inside the server racks fast enough to keep up with the processing speed.
Exactly. And this is where Astera Labs inserts its proprietary technology. They engineer highly specialized retimers and connectivity lines. You will often hear acronyms like PCIe, Ethernet, and CXL.
CXL is Compute Express Link, right?
Yes, Compute Express Link. It is rapidly becoming the absolute industry standard protocol for high-speed connections between central processors and external devices.
Okay.
Astera's hardware, like their Scorpio fabric switch, ensures that massive streams of data move across the CXL and PCIe pathways without any bottlenecks or signal loss.
But the hardware alone isn't what creates a nearly 76% gross margin.
No, hardware can eventually be commoditized.
Exactly. The real stickiness, the factor that locks these hyperscalers in, seems to be their software integration. I'm looking at their Cosmos software suite here. How does a software layer create a moat around a physical semiconductor component?
The Cosmos suite is a brilliant strategic maneuver. Astera embeds microcontrollers and sophisticated diagnostic sensors directly into their physical connectivity hardware.
Oh, wow.
Right. And then the Cosmos software manages this entire ecosystem. It provides cloud-scale operators with real-time telemetry, fleet management, and performance optimization.
So they can see exactly what's happening across the entire network.
Exactly. Once a hyperscaler integrates Astera's combined hardware and software solution into a cluster of, say, 10,000 servers, ripping it out is no longer just a matter of swapping a cable.
It's untangling an integrated management system.
The switching costs become astronomically high. It would be an operational nightmare for a hyperscaler to halt their AI training, rip out Astera's infrastructure, and try to integrate a competitor's system. They're effectively locked in.
And they really require that deep moat because the competitive landscape is formidable.
Oh, highly formidable.
Astra is defending its market share against absolute behemoths, most notably Broadcom. Broadcom has vast resources, they have an extensive portfolio, so Astra cannot simply rest on its current technological superiority.
Right. They have to execute complex business strategies to secure their position.
Which leads us to a really fascinating piece of corporate strategy. Astra secured what's known as a warrant deal with Amazon Web Services.
This is huge.
For the listener who might not be familiar with the mechanics of this, a warrant deal essentially gives Amazon the right to purchase stock in Astera Labs at a predetermined price.
Right.
But that right is contingent upon Amazon buying a certain volume of Astera's products.
Yeah.
Why is this such a critical maneuver against a competitor like Broadcom?
It is an absolute masterclass in vendor lock-in and structural alignment.
Really?
Yes. By offering this warrant deal, Astera essentially turns one of the largest hyperscalers in the world from a mere customer into a financially motivated partner.
Oh, because Amazon now has a stake in Astera's success.
Exactly. If Amazon hits their product purchase quotas, their warrants vest and become highly valuable, assuming Astera's stock appreciates.
Which it has been.
Right. It inherently incentivizes Amazon to standardize their data centers on Astera's architecture rather than Broadcom's.
That is brilliant.
Furthermore, Astera integrated themselves into the ARM ecosystem in late 2025.
Right.
That further embeds their connectivity standards into the blueprints of next-generation data center designs.
So we have established a phenomenal fundamental picture here. Highly profitable growth, zero debt, a deeply entrenched technological moat, and brilliant corporate partnerships.
Yes.
Yet, if we pull up the stock chart today, there's a clear disconnect.
There's a pullback.
Right. The stock has undergone a noticeable pullback recently. A lot of analysts are referring to it as a reset. How are we contextualizing this price action against the underlying business health?
It is vital to separate broad market sentiment from company-specific execution.
Okay.
The recent price action has undeniably spooked retail investors who were just accustomed to a straight lineup.
Sure.
However, when we aggregate the data from financial media and analyst notes, the professional sentiment remains overwhelmingly bullish. In fact, roughly 80% of the dominant narratives right now are framing this dip not as a fundamental deterioration, but as a strategic entry point.
You really see that narrative reflected in the financial press right now.
You do.
Let me read a few of these recent headlines just to give you a sense of the tone. We are seeing articles titled, "Most Attractive AI Crash of the Season."
Wow.
Yeah. There is another widely circulated piece called "The Market's Overreaction Hands Long-Term Buyers a Gift," and a very comprehensive breakdown simply titled "The Great Astera Labs Reset."
The media is clearly trying to signal that the baby has been thrown out with the bathwater during a broader tech sell-off.
Right. But headlines just provide a window into psychological support. To truly understand where the stock is heading, we have to analyze the underlying market mechanics.
Exactly. And if we examine the institutional flow and the options market, a very distinct pattern emerges.
What we're saying?
We are observing elevated implied volatility in the options chain, which suggests speculative repositioning.
Yeah.
But more importantly, our tracking of tech whale activity, the large block trades executed by major institutional players, indicates aggressive accumulation.
So the so-called smart money is stepping in while retail sentiment wavers.
Yes. These large institutional funds utilize quantitative models to identify discrepancies between a company's intrinsic value and its current trading price.
Right.
They are viewing the sector-wide weakness and the resulting neutral sentiment scores as a prime accumulation zone. They are quietly building substantial positions, anticipating the next major upward catalyst.
That brings us to the forward-looking aspect of this talk.
Yeah.
What exactly are these institutional whales anticipating?
A super cycle.
Right. What drives the next leg of hypergrowth for a company that's already pulling in over $852 million? The primary catalyst driving this thesis is the AI memory supercycle. Break down the economics of this supercycle for us.
The fundamental architecture of the newest, most advanced AI models demands an unfathomable amount of high-bandwidth memory.
Okay.
As a result, the macroeconomic demand for memory chips, specifically DRAM, has structurally outpaced supply. We are currently observing DRAM prices surging to roughly 4 times their historical baseline.
A 4x increase in the core component pricing. That forces the hyperscalers to drastically alter their capital expenditure plans, doesn't it?
Exactly. Amazon, Google, and Microsoft are rotating billions of dollars in CapEx specifically to acquire this high-priced memory to fuel their AI clusters.
Right.
But here is the critical intersection for Astera. As hyperscalers pack more memory and more compute power into their server racks, they immediately slam into that physical connectivity bottleneck we discussed earlier.
Because the distances are the same, but the data is heavier.
Yes, you cannot simply install 4 times the memory without upgrading the structural plumbing that connects it to the processors.
It's the equivalent of upgrading a sports car with a massively powerful engine and the most expensive racing tires on the market, but forgetting to install a transmission capable of handling the torque.
The car won't move.
Exactly. The hyperscalers are spending tens of billions on GPUs and DRAM, and they absolutely require Astera's transmission to make the entire system function efficiently.
Right.
The supercycle directly amplifies the value of Astera's moat.
That is the bull thesis in its purest form. The more capital the industry pours into memory and compute, the more indispensable Astera's connectivity layer becomes.
But to keep our analysis balanced and rigorous here, we really have to look at the other side of the trade.
We do.
Whenever a sector experiences this level of exponential investment, skepticism naturally follows. There's a prominent piece of research making the rounds right now titled 22 Reasons AI Data Center Construction is in a Bubble.
I've seen that one.
Yeah, we need to unpack the arguments they're making, not because we are endorsing a bear market, but because the broader market is definitely paying attention to these risks. What is the foundation of this bear case?
The core of the bear argument centers on the return on investment for the hyperscalers.
Okay.
The fear is that companies like Microsoft and Google are spending unprecedented billions on AI infrastructure, but the direct consumer revenue generated by AI tools has not yet matched that capital outflow.
The monetization isn't there yet.
Right. The article you mentioned, along with broader market analysts, argues that if these tech giants do not see a faster path to software monetization, they could abruptly slash their data center construction budgets.
So the risk is a sudden, severe contraction in capital expenditure.
Yes.
Add to that the ongoing market anxieties regarding broader tech valuations, specifically the immense weighting of companies like NVIDIA in the indices, and you have a recipe for potential downstream pressure on suppliers like Astera.
That's the fear.
If the hyperscalers decide to just pause the music and cut their budgets, how vulnerable is Astera Labs to a sustained contraction?
This is where we stress test the thesis. And the mitigation to this risk brings us right back to our fundamental analysis.
Let's hear it.
First, consider their financial armor. If a severe tech contraction triggers a credit crunch, the highly leveraged, debt-burdened companies face existential threats.
But Astera has no debt.
Exactly. With its 0% debt, it is structurally shielded from a tightening credit market. They can weather a prolonged storm without facing any insolvency risks.
That's a huge safety net. Furthermore, their historical performance suggests relative resilience anyway. Over the past year, they have posted a 78.1% outperformance relative to their peer group.
Right.
That indicates that the market recognizes a premium in their specific execution, even when peers struggle.
Exactly. But the most vital defense against the CapEx contraction argument lies in the essential nature of their product. Let us assume a hyperscaler decides to cut their overall AI budget by 20%.
Okay.
They might delay purchasing the next generation of GPUs, or they might build fewer server racks overall. However, for the data centers they do continue to build or upgrade, they cannot eliminate the connectivity layer.
You can't build half a data center.
Right. If a cluster is being built, it fundamentally requires CXL and PCIe infrastructure to operate.
They just can't cut corners on the plumbing without breaking the entire multi-billion-dollar investment.
Precisely. The hyperscalers' switching costs and dependency on integrated software like Cosmos protect Astera on the downside just as powerfully as they accelerate revenue on the upside. They are one of the last line items a hyperscaler can afford to optimize away.
We have covered a tremendous amount of ground here today. We've examined the phenomenal leap to $219.13 million in trailing earnings, the pristine zero-debt balance sheet, and the strategic self-funding of R&D in Taiwan and India.
It's a strong profile.
Very strong. We've detailed how their Cosmos software and CXL hardware create an operational moat that forces lock-in. supported by brilliant corporate maneuvering like the AWS warrant deal and their entry into the ARM ecosystem.
Right.
We navigated the market sentiment, acknowledging the recent reset while highlighting the institutional whale accumulation beneath the surface, and we've weighed the massive tailwind of the AI memory supercycle against the looming fears of an infrastructure bubble. Let's synthesize this complex picture. What is the final verdict for the listener?
Based on the synthesis of their financial health, their market positioning, and the macro environment, Astera Labs scores a highly bullish rating of 9 out of 10.
9 out of 10.
Yes. This conviction is driven by their elite growth profile, their flawless balance sheet, and a deeply entrenched, highly defensible technological moat.
And the analysts agree.
The consensus among top-tier analysts strongly aligns with this view. Forecasts suggest a 69.6% upside potential from current trading levels, roughly 70%.
That is massive upside.
Furthermore, analysts are modeling a sustained 29% annualized earnings growth rate moving forward.
A 9 out of 10 rating coupled with nearly 70% upside potential is an incredibly compelling thesis. But it is paramount to frame the target horizon correctly for you, the listener.
Yes, timeline is everything.
The case we've laid out today is not the foundation for a short-term swing trade. The fundamental health and the nature of the AI supercycle dictate that this is a multi-year hold.
Absolutely a multi-year hold.
You are looking at a company that is generating massive cash flow today while systematically embedding itself as the indispensable foundation for the technology of tomorrow.
The recent pullback, when viewed through the lens of objective data rather than emotional market reactions, represents a reset. It is a valuation opportunity created by broader sector-wide noise.
It's masking a highly profitable, debt-free enterprise that is perfectly positioned for multi-year compounding growth.
Exactly.
As we wrap up today's analysis, I want to leave you with a final provocative thought to mull over. We've spent significant time discussing how Astera Labs' connectivity solutions, both the hardware and the software, are becoming the absolute non-negotiable standard for AI data centers.
Right.
We know the switching costs for the hyperscalers are becoming prohibitively high. So consider this as you monitor the market. If this structural trend continues uninterrupted, are we witnessing the quiet rise of a company that could eventually hold the entire physical AI infrastructure market captive?
That's a fascinating perspective.
Could Astera Labs, the seemingly humble provider of the data center plumbing, eventually wield unseen monopolistic pricing power over the trillion-dollar tech giants themselves? It's a fascinating dynamic to consider as this technological revolution unfolds. Keep questioning, keep analyzing, and we'll be back to explore more soon.